Learning how to read crypto charts is essential if you're interested in crypto trades and following the marketplace. But, much like blockchain, technical analysis and market trends have a very steep learning curve. In the first part of this two-part guide, we'll go over the key concepts you need to begin your journey into technical analysis. The main concept you should understand from this video is Dow theory. It's a long-standing form of technical analysis written by Charles Dow. It was slowly released through the late 1800s in the Wall Street Journal. So what do you need to know about Dow theory? And how do its tenets apply to crypto? There are 6 parts to this theory. 1. Markets have 3 types of movements. The main movement is essentially the long-term outlook. How does the price of an asset look over the course of a year or more? The medium swings are price changes over the course of 10 days to 3 months. Finally, short swings are the smallest trend lines. How is the asset behaving hour to hour? Looking at all these trends is key to understanding how the market feels about an asset. 2. There are 3 major phases to a market. The accumulation phase is where investors that are in the know are purchasing an asset before the market catches on. Then the absorption phase begins, and rapid price changes begin as the larger public starts to participate. Lastly, the distribution phase is when early investors begin to sell off their holdings. 3. The market discounts all news. Any new information is very quickly reflected in the market. The sum of the world's hope, fear, projection, and history are all taken into account. 4. Averages in the markets must confirm each other. Essentially, this means that if solar energy stocks are surging in price, you would also expect solar panel manufacturers to be surging in price. Markets that rely on each other should generally move together. 5. Volume confirms trends. When there's a very small amount of actors in a space and there are price swings, it could be related to anything. It's hard to tell the motivations of one or a few people in a market. On the other hand, if price swings happen on large volumes, then it's more indicative of the state of the asset. When many people act in a certain way, it's a more clear trend. 6. Trends exist until they definitively don't. This one's pretty simple. It's basically saying to look at the big picture. Always give the longer-term trend the benefit of the doubt when there are short-term market swings. It's very tough to know when one trend is ending and a new one is beginning, so err on the side of the long-term pattern. So these are the 6 major points of the Dow theory, and I'm sure you can already see many of the ways that they apply to crypto markets. There are a few more tips we'll cover today that, when combined with Dow theory, can help to give you a clearer picture of an asset. Market cap, as we discussed in a previous guide, is a good starting benchmark. Coins with very low market caps tend to behave in a much less predictable manner, and vice versa. This ties in with the volume confirms trends tenet. If a few people are taking part in a market, it's very hard to get a clear picture. If there's a lot of activity, trends start to emerge. Relative Strength Index measures price movement by comparing the current price to past performance. It boils down to a ratio between the average of days the assets was up and the average of days it was down. Luckily, almost any exchange and trading tool will calculate this for you. RSI ranges from 0 to 100, and RSI over 70 tends to indicate that an asset has been oversold and will likely go down, while the inverse is true for an RSI below 30. By no means is this a foolproof indicator. If it was this easy, everyone would be rich. RSI is just one tool, like the other concepts we've presented here, to help you get a more clear picture of a market. The last concepts we'll cover quickly today are support and resistance. Support is the low end of an asset's value that is often touched multiple times before bouncing up again. Similarly, resistance is the high end of the value that is hit before the price tends to fall back down. They basically represent a point where people see purchasing an asset as a bargain, and a point when people see selling an asset as beneficial. So if traders think my coin is a bargain at $100, they'll leap in to purchase it when it hits that price, and it isn't likely to go much below there. If they think $150 for my coin is overvalued, or even just a nice profit, many will sell at that point and the price won't go much higher. Of course, there are many other potential reasons for this at play in any given market, but this is an introductory way to look at it. In the next guide, we'll look more specifically at different types of charts and more complex tools to help you understand markets. See you soon.